Hi, I'm back again. Having described all these data elements, we would like now to start really analyzing supply chains. And this is where we first move on to the so-called evaluate option. The evaluate option assumes you have put in data that describes the customer requirements. So let's get into the data. Here you see the item customer combinations we mentioned before. For each item customer combination, you need to gather data, whether from the past or for the future, say your forecasts. Demand that is expressed in the following way: the average demand for each item per time unit, and the standard deviation of demand for each item customer combination per time unit. Furthermore, you are required to put in your required customer service level on an item customer combination level. That means that for the same item, you may have different customers where you want to provide different service. In this case, we have assumed that the customer service level is either described in terms of a target ready rate or a target fill rate. The target fill rate is the most well-known customer service measure we know. It's the fraction of demand satisfied in time. And in time means that it's delivered according to the order lead time of the item. The order lead time in this case is 0, which implies that the customers expect to be delivered from stock. The order lead time is defined again per item customer combination, so it allows you to define different lead times for different customers for the same item. It also allows you to take into account that you're assembling to order or making to order. So if your assembly lead time is 1 week and you have an order lead time of 1 week, then basically it implies that you assemble to order. The margin is the connection between the cost price of the item customer combination and the sales price. The sales price in fact is 1 plus the margin times the cost price. It allows us to compute revenues. It also here is defined per item customer combination, which implies again that you can have different terms of trade to different customers for the same item. Let's look at the item input parameters. Here you see only the items in this case, and each item, each stock keeping unit has a review period, in this case 1 time unit, 1 day. A lead time. This item is shipped directly from the European Distribution Center in Breda, which means that the retailers stock for the Breda region in fact is 0 lead time. For the online stores we have 3 days, and for the other ones we have 10 days. The added value or added cost is the cost that is incurred in addition to the cost of the materials used to create the item from. You can think of this as the added value in terms of the cost per that is caused by labor, by maybe variabilized capacity, and maybe some materials that you didn't want to model because they were too cheap and not of great interest. And you can input these data by hand by yourself. The current stock or on-hand stock is the average stock on hand that you have computed from your ERP data in the past for each stock keeping unit. It's just averaging the stocks over time, over the period that you're interested in. The release cost is the same as the fixed order cost in the famous EOQ model. The yield is the fraction of the amount that you expect to be receiving. The fraction of the order you expect to be receiving after ordering. So 1 means that you expect to receive everything, and 0.9 would indicate that you expect to receive 90% on average from what you ordered. The maximum stock indicates the maximum stock that can be kept for an item, which is important for process industries where some item cannot be held at all. -1 indicates no restriction. The lot size indicates the average lot size, the average amount you order. Again, you can find this from your ERP system, or you can put it in yourself. The -1 indicates no lot sizing restriction, which implies in fact that the rhythm of ordering is completely determined by the review period. If we have now input all these data, we can start evaluating the supply chain. And this is the evaluate screen, where basically we find information on the supply chain in aggregate terms. But first, let us choose either the ready rate or the fill rate, and we decide to use the fill rate. We still agree on the 30% interest rate per year, and we evaluate the current supply chain, the as-is situation. And the information you're now receiving is cost information on an annual basis, the average investments that you have in the supply chain, and the operational performance in terms of customer service and in terms of stocks in time. Here you see the annual capital cost and annual material cost. The dead capital cost relates to the so-called dead stock, and that is stock that does not contribute to customer service. In the simple case of only end items, there will be no dead capital cost. Only when you start assembling and you take that into your supply chain model, that capital cost may occur. The annual release cost is also zero because we didn't put in any fixed order cost. The stock on hand investment, dead stocks, remnant stocks, pipeline investments, supply chain investment, and fixed asset investments are all computed from the data. Only the fixed assets are not included, and you can put them in yourself to get an overall picture. And here you see the computed actual and ready rate and fill rate for the current supply chain scenario, as well as the stock on hand in time and all the other stocks that we have put in ourselves, basically in the evaluate case. So here you get an overall assessment of the current as-is situation. Of course, we would like now to move on to the next step, where I would like to see what an optimized supply chain will look like. In particular, are we able to get a 95% required fill rate, and at what cost, and what cost in time.